Hello, I'm Mark from Moonstone Publications. As another year draws to a close, it's time to look back at some of the key regulatory and compliance issues of 2024 and what may lie ahead in 2025. And so with me in the studio today is Billy Seyffert, Moonstone Compliance's Chief Operating Officer. Hello and welcome, Billy.
Hi, morning, Mark. Thanks for inviting me.
The most significant development this year was the introduction of the two-pot retirement system. What are the primary challenges financial advisors face when helping their clients navigate this new system?
Traditionally, if one does financial planning, especially financial planning for retirement, in other words, the planning process up until retirement date, there were certain assets that made up this planning process. Advisors make use of existing financial planning tools. They make assumptions saying X has gone in, the contribution is Y, we're assuming a time period, and we're assuming a growth rate. And what's happening now is every time a withdrawal takes place, that entire portfolio is going to have to be rebalanced. Otherwise, the client is going to find itself, or him or herself, really a lot worse off at retirement. I don't think the compound effect of this can be underestimated. A 30,000 Rand withdrawal now, in 15 years' time, makes a big difference if that 30,000 Rand had been left there to grow. So I think the challenge for advisors are going to be, firstly, obviously it's never good to draw money from retirement capital. It's there for a reason, to fund retirement. So I think to try and manage clients, to look for other ways to access capital, and where not possible, that clients do not make disinvestments or have access to that capital without the advisor knowing about it and adjusting the plan, and then going back to the client saying, well, you remember that money that you took out? We need to supplement that. I think there's going to be a lot of tears 20 years from now if that advice is not followed, because clients are going to find themselves in a vastly different position at retirement than what was projected when, for example, the retirement annuity was entered into. And that's where I think the professional liability complaints are going to come in, that investments didn't perform as they should have or as was promised without taking into consideration the withdrawals. It has a massive impact on the compound interest calculation of retirement benefits at retirement. And I see that is going to be the biggest challenge. It does create good opportunity for further engagement and for advice.
The FSCA and the Prudential Authority have invited stakeholders to participate in workshops next year that will review the funeral insurance regulations. What do you see as the key areas of concern in the current regulations?
Mark, the issue regarding funeral insurance has been constant since 2004 when FICA came in. It has been the one matter that has never really been resolved. The licensing regime for funeral parlors, specifically in the insurance space, the problems with self-underwriting, the fit and proper regime, we've seen that being scaled down to now just an A-bet level. So from a compliance perspective, the funeral industry has always been problematic, and also the distributed nature and the rural nature of where some of these parlors operate from becomes a supervisory nightmare, not just from the compliance practice or compliance officer perspective, but also from the regulator's perspective. Doing on-site in the deep rural Eastern Cape, it's practically not possible. I think one of the main things that is spurring a lot of the unhappiness is the change of the definition of group. in the past, before the amendments to the Insurance Act, funeral parlours were really, they were typically a master policyholder, and they could add members, but they were the policyholder. So when they wanted to terminate an underwriting arrangement with one life office and move to another, it was as simple as doing that. The changes to the definition of group now means that most parlour client arrangements no longer constitute a group, and those moves can only take place with customer consent. And again, getting hold of customers, getting evidence of that consent in this industry is very problematic. If you ask me what's my opinion regarding this, whether it was correct in changing the definition, I think the problem that policyholders were being moved from one insurer to another without even knowing from week to week who their current underwriter is clearly not a good outcome for customer. Whether the change to the definition achieves that, yes, well, it does achieve that. Is that achieving it in the optimal way? Probably not. Whilst it's preventing certain things, it's also stopping other things from happening for really finding better benefits, etc. So, likely, I suppose one of the outcomes here is going to be, it could potentially be that they look at really just putting rules in for moving a scheme and not maybe just about the constitution of a group. I mean, honestly, the staff turnover in the advisor turnover in the funeral industry is of such a nature that it's really impossible to actually try and keep a register updated and giving that information through to the FSCA. That's problematic in and of itself. I mean, the fit and proper regime hardly finds application. ABET level 1, in other words, being able to read or write, just the KI needs to do REs, a little bit of product specific training, but for the rest they're really exempted. So I don't see that is going to be a big focus point. I think the discussion is going to be to find a environment whereby parlours have enough control over their books, if we want to call it that, but also that sufficient consumer protection still stays in place. And the other thing is, obviously, the micro-insurance framework was arrived at for a reason, and the uptake in micro-insurers have just not been enough. And I think some root cause analysis of why this uptake is not taking place is probably going to be deserved. And the other problem is once you're a micro-insurer, the Prudential Authority, they're a very serious regulator. They've got a massive role to play in the financial stability of this country. Insurers like the large life offices, I mean, they're fundamental to the economy. But perhaps a little bit more of a lighter touch when it gets to the micro-insurers in terms of their prudential requirements, their reporting requirements, could possibly also be the stuff that they're looking at. We'll be partaking in that discussion, and looking forward to seeing what actually comes from it.
This year we saw a continued focus on anti-money laundering and FICA compliance. How are accountable institutions doing in meeting the expectations of the Financial Intelligence Centre and the FSCA?
FSPs are miles ahead of other accountable institutions. Yes, I mean, they've been under the FICA regime since 2004, basically. But I think, we're finding that the guys have got RMCPs in place that are doing what it should be doing. They are doing their KYCs on the new clients. The FSPs specifically are more or less where they need to be as far as new business is concerned. We're finding that the sanction screening and review of existing clients is probably not where it should be. A lot of focus is on new business. If we look outside of the FSP as accountable institutions, then I think it is still very much Wild West there. The FIC has made no secret that they're targeting the property practitioners and the legal practitioners, and we've seen a lot of regulatory action, on-site supervision taking place. So next up is the high-value goods dealers, and here I foresee very difficult times. If you look at the FIC report about how many high-value goods dealers have registered as accountable institution, and you just compare that just to simply for motor dealers in South Africa as accountable institutions, about a quarter of them have registered. There's a perception running around in the market that if I don't register, the FIC doesn't know about me and I remain under the radar. And that is a wrong perception. We've seen it now time and time again. The first step that the FIC takes if they approach you as a high-value goods dealer or any other form of accountable institution, and you have not registered or submitted an RCR, immediately it's a 25,000 Rand fine. If you send proof of registration, typically you get reduced to 10,000 Rand. So what I'm saying is, if you are a high-value goods dealer and you should have been registered by now and you're not, you're already in for at least 10 grand. And that's going to be the start. Then we're going to look back at saying, well, okay, what have you done of your KIC? What have you done about your sanction screening? Where's your RMCP? Mark, we've seen these fines. 7.7 million Rand, 2.2 million Rand. I cannot overestimate the importance that people need to register and come on board. But getting back to financial advisors, there's a number of challenges in the industry, specifically regarding the requirement that you do your sanction screenings before you establish a relationship. In many instances, for example, in the asset management space, where it's an outsourced asset manager of a collective investment scheme, on a model portfolio or a bundled product, the fact of the matter is the fund manager as an FSP only knows about the client once the money has already been paid into the fund. So that before you do a single transaction or before you establish a business relationship thing is simply not feasible there. If you look at it outside of the financial services space, take auctions, for example. People arrive at auctions, they want to register and they want to purchase. The auctioneer finds itself in an impossible situation to do this verification before registration. Yes, I understand if it's an online auction or it's taking place, somewhere where there's signal. But when an auction is taking place on a farm somewhere, the technology simply does not exist to do that pre-sanction screening. So I think there's a couple of things in the legislation that, although has the right intention, is simply not practically feasible. And I think those are the challenges that we can look at. And I think the FIC specifically needs to deal with those things by means of PCC. Because you can't be found to be non-compliant in a situation where it is simply impossible. I'm not talking about not practical, I'm saying impossible to comply. But I think at consumer level, everybody's suffering from FICA fatigue. You are so sick and tired of people asking you for ID, proof of residence, source of funds, that FSPs are getting to a point where, they're sensitive about requesting this information over and over again, because at the end of the day, a lot of financial advice is still a sales activity, and you want to make it as easy as possible. I think one of the bigger things that we're finding is that where the client is a corporate, the FSPs are almost embarrassed to ask for that information. But the fact of the matter is, it's the law, it's a requirement, you have to provide it. And I think if you just explore a little bit further, you're going to find that all these corporate clients have got all this information in a file already, to send to you at the press of a button, because they get asked for it by their banks, by anybody that they render a service to. Even if they want to make use of the services of an attorney, they're doing this stuff. Even at Moonstone, we get these requests and we have this information available. I think FSPs need to understand that their clients know that this is a requirement and they probably have the information, and they shouldn't be shy to ask for it. It's part of doing business in this country now, and in fact, part of doing business anywhere in the world.
Joint Standard 1 of 2023 on IT governance and risk management came into effect in November. And Joint Standard 1 will be supplemented by Joint Standard 2 of 2024 on cybersecurity and cyber resilience. This standard will take effect on the 1st of June. How will these joint standards affect the way financial institutions manage their IT and data risks?
So in terms of the current fit and proper determination, Board Notice 194 of 2017, they are already under the operational requirements or operational ability requirements, provisions regarding risk management, security, backup, etc., etc. That does not get replaced. These two joint standards are in addition. These are specific requirements for the institutions identified in those standards. And Joint Standard 1 specifically is really about compliance. It is about having a strategy, having risk management plans, having policies. So, yes, the point at the end of the day is to have cybersecurity, cyber resilience, customer protection, secure network environments. But the point of Joint Standard 1 is to set a governance requirement on those affected financial institutions to actually have this stuff documented, have a plan, having board approval of it, saying what you're going to do and how you're going to get there, how you're going to monitor it. So the outcome here is one of compliance, evidencing that you've got these things in place. Obviously, then the IT or the cyber part of it comes into play. But those are technical controls. Those are the things that you implement to give effect to the policies that you say. Joint Standard 2, on the other hand, speaks a lot more to minimum requirements in terms of technical controls. So Joint Standard 1 sets a regulatory environment there for governance and requirements that you have certain policies and structures in place, and Joint Standard 2 sets the requirements specifically for the technical controls. I don't think they should be confused. And remember here, the outcome here is not that you're not hackable. The outcome here is not that nobody in your financial institution still clicks on the email from the Nigerian prince. It's about setting good industry acceptable standards there. And if something is lost, that you can recover it. If something breaks, that you can fix it. That's the outcome here. And the other important thing that people should consider is the more you have in place here, the more it's going to impact a positive premium when you're looking at cyber insurance. Cyber insurance is exhaustively expensive. And the more you can evidence in terms of both policy, procedure, but important technical control, the more you are going to save on premium. The fact of the matter is any business, not just financial institutions, have these risks. The amount of business email compromise that takes place on a weekly basis, it's absurd. And you don't want to be on the wrong side of that, because if you comply to Joint Standard 1 and Joint Standard 2, the chances are that you're going to be found to be negligent are very, very slim. Look, we accept 9 times out of 10 it's the client's Gmail that's been hacked, not the financial institutions. But you want to be in a position to say, I've got everything in place that I need to have in place. This likely did not take place at my business.
Thank you for your insights, Billy. And thank you to all our viewers and the readers of our newsletters. The team at Moonstone Information Refinery values your support. We hope you have an enjoyable and relaxing festive season and a prosperous new year.